Hey everybody, welcome to the VIP Financial Ed YouTube channel where we help you go further, faster financially. And we've got a very special training for you here today. As you can see, I've got my guest, Mr. Jim Beam. Yes, that's his real name. And we talked about it earlier. We think turning this into a drinking game might be the best way to go about teaching you guys this information.
Lots of hits.
That's right. I'm telling you that after you see what I'm going to show you today, you will want to celebrate with a drink. So, guys, this is known as the universal whole life infinite banking concept debt weapon exposed, and we're going to teach you everything that you did not yet know about what makes whole life both special and dangerous. So make sure you stick around. All right, guys, so got Jim Beam here today, associate partner with Miss Rebecca Rice and Associates out of Little Rock, Arkansas, has partnered up with Jim, and these guys are dominating the country as the leading experts in both education and implementation of what many people are going around and teaching is the infinite banking concept. This is something that can be far more simplified. And I was telling Jim earlier today that my word for the year is simplification. I want to come to you and just show you guys how much easier life can be for you when you worry about optimizing cash flow. We talk all about this. So there are three main steps you're going to learn by subscribing to our channel below. Make sure you click the subscribe button if you haven't done so already. Select the bell when it comes up because that will allow you to get notifications anytime we upload new content to this channel. Guys, ultimately this is the nuts and bolts behind what we do. We talk about having access to this diverse collection of what we call debt weapon accounts, and these are tools that essentially allow us to achieve that result of going further, faster financially. And this tool happens to be one of my favorite for a number of different reasons. We're going to get into that here throughout the training today. But we talk to a lot of groups. Jim and I know each other from traveling all over the country, sharing unique ways of banking with the real estate communities. You know, I ask the audiences so many times how many people have read the book Rich Dad Poor Dad or the series by Robert Kiyosaki. It's truly a cult classic in the industry. It's very rare when at least 60-70% of the room doesn't raise their hands.
At least, yes.
So this is going to be one of those subjects, and probably help if I mic up.
There you go.
All right, so this is going to be one of those educators that really promote what we teach, which is, you know, borrowing and leveraging to create wealth. And so he's got this quote that I wanted to share with everybody here today, that it's not about the money that you make in your life, it's about how much you keep, how much is working for you and how much you're leaving as a legacy. And this is such an important subject. This is why when we discuss the three steps of credit, capital, and cash flow, that really the end result is that cash flow stacking process where you're ultimately left with as much money at the end of every month as possible. And when you have this disposable or discretionary income, you've got these choices. And ultimately, this is your freedom, guys. This is what allows you to go where you want, when you want, and stay for as long as you want. But so much of this bottlenecks. And what I've asked Jim to do today is to really give us kind of a deep dive explanation into one of these powerful debt weapon vehicles known as whole life, right? Let's call it what it is.
Whole life insurance.
That's right. You know, I'd kind of like to start off, Jim. First of all, let me just, you know, give you a basic background on Jim. We do our homework, as you guys know, if you followed any of our channel in the past. Anytime we have a collaboration where we bring in somebody that is known as the leading expert on a certain subject matter, we really want to check it out first. So we've looked into Jim. Obviously, we've shared the stage many times together. Furthermore, you know, Jim's company has an A+ rating with the Better Business Bureau. Rebecca Rice and Associates, also a phenomenal individual in this industry. Truly, kind of the mother, she's kind of the mother hen of this. That's right, exactly.
Absolutely.
And so, you know, these two have perfect reputations industry wide and are really out with the love and passion that I think is required to deliver this message the way that you deserve to hear it, which so often, Jim, we find that this concept is manipulated into this packaging that is so attractive, whether people call it, bank on yourself or become the banker or, infinite banking concept. Ultimately, it's this idea of gradually eliminating the need for banks in your life ever again and stepping into that role. How amazing and powerful this could be, right? Think about that. But it's dangerous too, right? You get this into the wrong hands and you've got people who are directing folks that don't really belong in this solution, right? And
right.
and ultimately it's all about a competition for the business because there's this commission at the other end, right?
Right?
And everybody wants that. You want it, I want it, everybody wants this commission, but so it kind of prevents some people from really shooting straight with what this is, how it works, how it can benefit you. So let's really kind of start first with a little background on yourself. Why don't you tell listeners a little bit about you and why this is so important to you, and then let's take a look at some numbers.
Fantastic. Jim Beam with Jim Beam Financial, partnering up with Rebecca Rice and Associates. And I got into this business, if you will, of financial advising as a client of Rebecca's, okay? And she started showing me some of these strategies that I can use in my own business and in my own life. And after some time, I asked her, I said, Beck, how can I start to use this? How can I show this to other people so they can take advantage of it in their lives? And you've got to meet Becky. So you can just picture her saying
and
this.
we're going to have her on the channel throughout the year too. So you guys keep your eyes peeled because there will be a lot of fresh content in coming months. So just make sure that you subscribe.
Yes, so Becky said, why don't you quit your job and come and do what I do?
Now, at the time, you were managing, what, $500 million worth of real estate holdings or some outrageous number at that point?
Doing real estate investing privately on my own, but I was working for a large general contractor, building high-rise condominiums on the beaches, $100 million buildings, and doing very well. We were making good money, and we were making good money in our real estate, but it just seemed like at the end of the day, somebody was taking it all away. And
somebody is, right?
And
that's exactly what we're going to see.
Right. It was like, okay, like many people that we work with today, it's I work really hard, I pay my bills, and I get to keep what's left over. And I had enough of that. Okay, so my quest for learning more about finance brought me to Rebecca, and she started showing me some amazing strategies, and this is one of them. And I said to her, how can I help more people learn about this amazing information? And she said, why don't you quit your job and come and do what I do? And so we did. It was about a 2-year transition, and I got into the business and I learned what she learned, and she taught me a lot of great things. This strategy is one of them that we use quite often, okay, in our financial advising. And what's our goal? To improve our clients' financial position by freeing up cash flow, helping them keep more of what they earn, make it work harder for them, and then pass it on to the next generation.
Exactly as Kiyosaki describes it, guys. This is all about leaving a legacy and keeping what you're already earning. Why do you want to either A, continue doing what you're doing, B, live in a world of sacrifice and giving up all the luxuries, things you enjoy spending your money on, or 3, have all of your money just simply going out the door into abyss to interest, and you can go on sacrifice. I mean, at the end of the day, we talk about the idea of budgeting. I just don't know many people that are successful at it. All right, so what I'd like to do now is just dive right into the numbers. We all know that I'm a huge numbers geek. I like to see the math for myself. If you can prove to me that there's a better way,
Absolutely.
It's faster and it's less expensive and it's safer, then I'm on board. And you guys should be too. So let's take a look at, number 1 on the screen here, we see illustration period. Illustration period represents basically somebody's work lifespan, right? This is how much longer from today you think you're going to be either capable or desiring to work. And so let's say I'm 35, right? I wish.
Yeah.
And I want to work another, say, 30 years.
It's entirely possible.
I'll probably work until I die. Most of us entrepreneurs and investors probably can never sit around doing nothing, getting stale. But let's say I want to quit working at 30.
Got it.
So let's start with an illustration period of 30 and then go from there. So then what annual income is just what that would represent for my household, basically?
This is your household income.
Okay,
True.
so let's say husband and wife making $50K each, $100,000.
$100,000 a year.
Okay.
Okay, and so the folks watching, what we're attempting to illustrate here, what we're going to illustrate is just how much money is going to come through your system in your lifetime, okay? And how quickly it can go away.
I was going to say, I have a feeling this is not actually a fun exercise to watch.
It can be painful at first, but it has a happy ending.
Okay, all right.
It has a happy ending.
I'll trust you on that.
Okay.
Let's
and
see.
just how quickly it can go away if we're not doing things with intent, and then we have to come up with the solution. So there's our family making $100,000 per year, and they've done that for 30 years. It's pretty easy math. They've got $3 million at the end of their working life.
Before all the variables are factored in, right? So
$3 million they've earned.
that's not so bad.
It's not hateful. It's actually a lot of money.
That's without any taxes.
Adding taxes.
Without paying for this glorious lifestyle I want to live, right?
Indoors yet, right?
Debt servicing, of course, right? We need that mortgage so we can get the house,
right.
and then also we haven't factored in, raises and income increases and all
Absolutely.
that stuff, right?
So if you've been around long enough to know, and I have, that $100,000 today isn't going to spend like $100,000 30 years from now.
Not even close. No.
Okay.
I can agree
So
with
let's
that.
give our family an increase in salary every year, say 3%.
It's modest. I think it's fair.
Okay. So now out here to the right, they've earned $4.7 million. And that's a lot of money.
That is because of the growth, the compound effect of the income increase is 3% of the 3% increase from last year, and
That's right.
of the 3%. So now we're at $1.757 million more than if we didn't earn 3% more each year.
3% each year. Right.
Seems
And
pretty
so
good.
You can see here in the last year, their last paycheck year, they make $235,000.
Okay.
Okay, perfect. Now, in order to illustrate the maximum potential, let's put an earnings rate on there.
Okay.
Let's just assume they have one of those jobs where the boss pays for everything, housing, food, clothes, cars, and they could keep all that money and earn interest. So let's give them an interest rate out here at, say, 5% annual earnings. Okay. $9.9 million is their maximum potential. That's
Wow.
how much money is going to come through their system in their lifetime.
It's almost $10 million.
It's almost
at
$10 million.
$100,000. Yeah, that's outrageous.
Now let me ask you a question. You're our happy family.
Okay. I'm happy with $10 million.
And I said to you, Matthew, the boss loves you. They're going to, in fact, they want to keep you around for 30 years. They're going to write you a contract.
Deal.
And they're going to say to you tomorrow when you walk into work, Matthew, we're going to write you a check today for $10 million. You're going to work here for 30 more years, but that's it. That's all the money you're ever going to make.
Oh, well, I would be tempted, but I'll never sell my soul. So
Well, would you think
it's
about
a pretty good money for 10 million doesn't sound so bad.
It's not so bad. Would you think about that differently if you had $10 million in one lump sum than you do check every 2 weeks?
Yeah, I would.
Absolutely.
Without a doubt.
Absolutely. And so the paradigm shift needs to be this. We need to start thinking about our check every 2 weeks the same way that we would think about if we had $10 million lump sum check tomorrow. Okay? Let's move on. So we know we can't keep all that money.
Exactly. That's what I'm most afraid of here is this number is falsely representing.
That's right.
Okay, so let's look at the damage.
So the first damage is, and I'll give you a clue here, what is it?
Obviously taxes.
We've got to pay taxes.
Taxes and debt servicing are going to consume probably about a third of this each, right? So
It's going to be a lot.
So what do we say? 38, 35%?
Well, let's break it down. You have federal income tax. Some states have state income tax. We have property tax. You buy a vehicle, you pay tax. There's tax. Everything seems like it has a tax.
Sure.
And we start to see that number approach 40, so let's put our 38%, 38 cents out of every dollar we make, taxes.
Okay.
Matthew, our family's income, look at that.
Knocks it down from almost 10 to just over 6 mil. Okay.
Exactly. Now here's a very important concept. You'll notice that they only paid about $1.8 million in actual taxes.
Yeah, I see that.
Okay, but it cost them 3.7, almost $3.8 million. Why is that? How can that be?
I mean, I would have to assume it's just based on opportunity cost. It's the loss of their tax consequence each year that's no longer contributing to the compounded effect of the long-term money, right?
You got it. So if they could have paid that $1.8 million in taxes at the very end,
Yeah.
okay, then their cost would have been 1.8.
Yep. About half of what it ends up being.
That's right.
Yeah.
That's right. But if you look at the red bars, that represents the tax draw on their maximum potential.
Yeah, look at that last year.
Yeah. And so every time they pay taxes, that means over here in earnings, they don't earn 5% on that money because
right.
they pay tax.
Okay.
It would have grown to 3.7 million.
And the problem with this is it's only going to be exacerbated by this debt servicing, which is probably in the same ballpark. We know it's in that 30 to 40% range for a lot of people between mortgage and non-mortgage related balances. What are we going to use for this number?
Well, and you've heard the numbers before from different folks, and it's true. It's about 34% of every dollar that we make goes towards debt service.
Okay, so let's call it an even 35%. I'm curious.
Okay, let's call it 35. But before we show the answer, let's
tell
talk
I'm always
about
antsy, right?
That's right. What is debt service? We need to define that.
Okay.
Okay, and when I ask that question of folks, the first thing that usually comes out is credit cards. Interest that we pay on credit cards, or banks, or borrowing money from other people. And that's true. But we also want to illustrate that, what if you pay cash? Is there a cost to money if you pay cash?
Without a doubt.
Without a doubt.
Of course there is. Yeah, if you miss out on leverage, listen, we're not advocates for a debt-free life while so many of our videos talk about the power of 100% debt freedom. That's not the case at all. We're talking about accelerating the elimination of balances, but relying on leverage perpetually to get ourselves into those new income streams faster, right? So we want to use money and leverage it, but yeah, you're right. I mean, where would that put us then if we're factoring in the actual opportunity cost of using cash?
2.6 million.
Okay.
2.6 million.
That's pretty amazing. So we've come from 9.95 mil to 2.68 mil, and we haven't even factored in eating.
You haven't eaten. You
I have no
indoors?
Shelter.
Right.
Right.
And you're walking.
I'm walking everywhere.
Yeah.
Exactly. And I'm naked.
Exactly. So lifestyle. That's what kind of car do you drive? Where do you
Right.
go on vacation? What kind of house do you live in? What's your lifestyle?
It's also things that a lot of us take for granted but are factored in more into the utility side of living. You know, those are discretionary costs too. The fact that you have electricity and gasoline on is discretionary,
Absolutely.
but it's a cost nonetheless, and it can add up, right? So
betcha.
normally we'll see a number in here of, say,
25%.
okay, I was going to say about a quarter of what you're bringing in. That makes sense. Ouch.
190.
So wait, that dropped to just under 200 grand?
Just under 200,000. Just
Okay.
under 200,000.
So this got uglier than I even thought it would get.
Absolutely. Well, how does that make you feel? You're the happy family making $100,000 a year. Your last year's income is $235,000, and you just retired with just under 200,000 in the bank. How does that make you feel?
Well, I have an unfair advantage because for the last dozen years I've been watching people's cash flow cruncher spreadsheets come in, and I see how little is left over each month.
That's right.
Based on enormous earnings. I mean, most people that are watching this channel or coming to our live events are more than capable of earning a fairly significant income.
Yes.
It's a matter of what of that is left over, and that's the scary part. All right, so what I really want to do is I want to move through the problem, right? We know the problem. If you're not already aware of your problem, that would be number one step, right? Before you find the solution, at least recognize that there's an issue here. And so this highlights that issue. What I want to do is say, okay, what if things got just a little bit better? Okay, we don't have to go and create this over optimism and sell you some fake, false, impossible dream. That's not what this is. Let's talk about optimization in areas of your financial circumstances that you already don't enjoy paying. So what if you didn't have to pay as many taxes? What if you didn't have to pay as much in debt servicing? So what if you were able to lean on a debt weapon solution that provided you the ability to do both of those two things all in one? What would that look like? So let's take a look at this tax field, right? What happens if we were able to utilize what you're talking about and improve taxes? What would that realistically have the ability to fall to?
Well, let's take a look at it. And this is one thing I love about math. Because the numbers don't lie, right? The numbers don't lie.
That's right.
So what if we can understand taxes a little bit better, and maybe use some debt weapons to help us mitigate some tax?
No question.
And we can get that number down to maybe, I don't know, we're going to call 30, 32.
Yeah, absolutely. And guys, while he's doing this, I just want to point out there's another training on our website, on our channel, known as How to Build a Business Bigger Than You. And this is taught by professional experts on the subject of tax strategies, where you can minimize some of your tax consequences. There are many, many different ways of doing this. And part of the process that we each teach on is the ability to create that entrepreneurial lifestyle where you can take tax deductions for certain things that you otherwise wouldn't be able to if you didn't have your own entities. So part of what we're teaching in other subject matter, I just wanted to point out that those subjects are a part of this channel. In the meantime, I think a 6% reduction of outstanding tax consequences is more than conservative for purposes of this example. So if we were to go to 32, you jump from a little under $200,000 to almost $800,000, so almost 4 times the amount. How does that work? I mean, you're going from down to 1.5 in actual total costs, but the actual loss is now reduced to just the 3.18.
3.18. You got to keep more.
Right.
And you got to earn your interest.
That's right.
More.
And that compounding effect over the long term creates a 4x value on that then. So what happens when we implement the other techniques using the same debt weapon you're going to talk about, among many others? It's a collection and a collaborative effort between these. Let's say we drop debt servicing to 25. Keep in mind, guys, that our debt servicing reduction for most people can be as high as 75 or 80% of future interest costs that you're going to pay. So I think this is a more than conservative number for us to plug in. What does this do to the number?
1.79, 1.8.
So you're jumping from 800,000 now to more than 2 times that, to almost $1.8 million.
And let me ask you a question, and this is important. How much risk did you have to take to make that happen?
I think that's the point that I've been trying to make on previous videos over the last 2 weeks, which is, how is this not less risky? Where it's not only that I didn't have to put in any more risk, but this is actually creating a much safer financial profile for me, right? I have a much safer likelihood of actually being able to retire at 65 with 1.8 mil versus 200,000. I also have access to significantly more money than I had access to before. Yes. I have significantly more left over at the end of each month, so there's money in the event of emergency. My credit scores are obviously much, much better. Yep. If property values decline, what do I care, right? Because we're using this, and not only are we preventing debt servicing costs, but we're eliminating balances in a small fraction of the time, so you own your homes outright. Where's the danger? I would ask you.
There you go. And let me ask you a question. The $1.8 million, what if you had access to liquidity, use, and control of that money all along the way? How much more of a bigger impact could we make on reducing your debt service?
Not only that, but also increasing the asset side of the balance sheet too, right? If I want to use that and go out and actually acquire new income streams, invest in my business, invest in my real estate portfolio, invest in consumer-related discretionary items or lifestyle design, it's available for use for any reason whatsoever, right? So let's turn our attention then to the nuts and bolts. I mean, I think people are starting to get the visual mathematically of why it's so important to take a real deep look at what we're about to share with you next. And we mentioned it in the beginning of today's training. It's super simple, guys. It's all about whole life insurance. Don't let other agents try to bamboozle you or just kind of create this spectacle of something fancier than it really is. Why are people so afraid to be transparent about the topic of whole life?
What I've seen is that the whole life insurance has kind of gotten a bad name in the industry.
Why?
Well, I think they're afraid to call it what it is because they don't understand it and how simple it is and how much of a tool it can be used in our finance, all right, as a debt weapon, okay?
Perfect.
And I think adding some of the sexiness to it and calling it something fancy, all right, makes it easier to sell. Okay, but if we really just dig down into it and see the mechanics of it and how very truly easy it is, let's call it what it is. It's whole life insurance.
Okay, show me.
Okay, so the first thing I want to illustrate to you is you've all seen the penny game. Okay, and some of us probably saw this in our elementary school years. If you took
this is where it double
a penny's value every day for 31 days. Okay, how much is that?
I can't remember the exact number. I know it's million. It's I mean, it really is a mind-boggling number.
It's $10 million. It's over $10 million.
Okay.
And so, with that illustration, we're able to see the power of compounding. How 1 penny can turn into $10 million
in 31 days.
In 31 days. Okay. And so in this illustration that I'm showing with the calendar, we see how that happens, because a lot of people just can't comprehend that. They can't believe that can happen in that short period of time. But if you'll notice on the calendar, in day 20, there's like $20,000. Day 22, there's $20,000. And so if we were doing this calendar and you had money compounding in this calendar, you came to me, Matthew, and you said, day 22, Jim, I've got a family emergency. I need to take that money out of the system. I know.
Yep, rainy day fund.
Rainy day fund. And I said, sure, I can do that. But as a friend and as an advisor, we have to talk about what would happen if we took that money out on day 22. What do you think would happen on day 23?
I'd be starting over.
You'd be starting over.
Yeah.
So you got 1 penny now on day 23, and it compounds.
To 2, to 4, to 8, to 16.
Right. And so what does that do to your compounding?
So 31, I'm at $2.56 now.
$2.56 now.
Plus the 20 I took out, right?
Plus
So
the 20
21 I took out. So yeah, so I'm a little worse off.
It's a long way away from $10 million.
It sure is.
Right? So that illustrates what happens when we interrupt compounding.
Okay. So the beautiful thing about this specific debt weapon, beyond the fact that you don't even need your own personal credit to get it.
True.
Now, this is a little off topic, but I'm curious, can another debt weapon be used to purchase one of these debt weapons?
Yes, it can.
Interesting.
It can.
Okay.
It
And we
can.
could talk a little bit about that
That would
in
be a really good second video.
Guys, keep in mind that we do have a surprise for everybody coming up at the end of today's training, so make sure that you're paying close attention and sticking around to the end, because Jim has a very, very special gift that he's been generous enough to give. Both he and Rebecca Rice are preparing to set you guys up to succeed with this. So, okay, so I see the point here. So how do we prevent this from happening? Let's say that I'm investing in this debt weapon instead, right?
Okay.
And then let's say that I need the money.
Right.
Well, what makes this so special?
Okay,
Whole life.
so let's just use our pennies to finish off the simplicity of this. So on day 22, I recognize your need and I say, Matthew, it's okay. I'm doing okay. Why don't I lend you my money? I'll give you my $20,000. Okay. And we'll let yours continue to compound until day 31. Right? What's that do for you?
Camera.
Right? What's that do for you? It allows your money to continue to compound, and you get to your $10 million.
Right.
Now you can clearly pay me back.
Exactly. Plus
right?
interest.
Plus
Maybe,
interest.
if you're
you'd
lucky.
probably be happy to pay me interest.
I suppose.
Right? So that illustrates leveraging.
It's power.
Leveraging.
Right.
Okay? And we can do the exact same thing with our whole life insurance policy.
Okay, so I can draw against it. It continues to grow as if I have not used the money.
Correct.
And I pay it back, almost in a sense, becoming the bank. I'm stepping in the middle. Let's talk a little bit about the concept of earning the way the banks earn.
Okay.
So you have a little information. I'm curious. Talk a little bit about how the banks are earning money.
Let's talk about that. So we'll use some hypothetical numbers. Okay, so if I were to put my money in the bank, let's say $100, and say the bank agreed to pay me 6% interest.
Okay.
Pretty cool.
Not
Sounds
bad.
like 1980s.
Yeah,
Right?
really. Yeah. I mean, trust me, I'm moving banks if that's what
That's right.
if that's what you're getting.
But if they did agree to pay me that much, they're going to want a spread to loan, say, you the $100.
Right.
They might loan it out at 15%.
Right.
Okay. So it sounds like the banks are making 9%. They get the spread. But we always want to chase the dollars and not just the interest rate. Okay. So if I had $100 in the bank at 6%, they're going to be paying me $6 at the end of the year. Okay?
Sure.
You borrowed that $100 from the bank. Now, whose money was it?
Obviously, I'm borrowing yours.
They're loaning you my money.
Exactly.
And you're paying them 15% to use it.
Sure. Yeah. Very
Okay.
easily.
So $15. Okay? So how much did the bank have invested in that deal?
Well, none of their own, but you could make the argument that they invested $6 to pay you.
I would say that. They had a commitment to me to pay
Sure.
$6. So the bank has $6 investment, and they made a $9 profit.
Sure.
So really, anybody with a calculator can figure that out. It's 150% return.
Okay. So as the devil's advocate, you're showing me a $6 payout or cost of me or revenue or return on my money sitting in the bank of $6 or 6%. I know that's not real.
Right.
Tell me a little bit about today's numbers. What does that look like if I'm earning 50 cents on my money?
Okay, I'll take that. And there's also a reason why I'm using 6%, and I'll show you that in a minute.
Okay.
But let's use today's numbers. Okay, so 50 cents. So they have 50 cents invested in the deal. If I went for a car loan, I could probably get the car loan for
5% or less. Call it 4.
Call 4.5%.
Yeah.
So now the bank's making $4 on a 50-cent investment.
800%.
That's 800%.
Right. So it's only getting better for the banks as the interest rates are more accurately depicting today's.
That's right. And the importance of that, the takeaway is the spread can be deceiving. It's not 9%. It's 150%. Now, can we go do the same thing?
That's the whole point. I mean, isn't that what we're trying to do?
Absolutely.
So show me how to do this.
Absolutely.
This is why they're calling it becoming the bank, right?
Well, we don't call it that. I like to call
it's
it
whole life
insurance.
Exactly.
Right.
But this is where that wrapper has come from. Is you suddenly have the power, the same types of margin potentials that the banks do.
Absolutely.
Okay. So how do we do that?
Okay. So we've got an insurance company. We'll talk about the process. How does this work? Okay. We've got an insurance company. You put your money in the form of premiums. Okay. And the insurance company promises you a certain death benefit protection.
Right. Exactly. I thought that's what most people were getting. Life insurance.
That's
makes sense.
That's right. And that's what it is. And that's where most people stop thinking about the life insurance contract. Okay. But we need to take it a little bit farther. Okay. With a whole life insurance policy, though, there's a certain cash value associated with that contract. So at any point in time during your life with that contract, there's a value to that contract. Okay. And it's a cash value. If you called the insurance company and you said, that's it, I'm done with life insurance, send me my money back, that's the value they would use.
Interesting. Okay.
Okay. But we don't ever want to do that.
Right. Exactly. We just want it to keep growing because of the compounded nature,
Just
right?
like the pennies.
Exactly.
We want it to continue to compound.
That's right. Okay.
Now, interestingly, there's more language in that insurance contract that talks about the loan provision, how we can borrow the insurance company's money and use the collateralization factor on our cash value. We can use the insurance company's money to go take care of our business. Okay? You see where we're headed with this?
Yeah, absolutely.
And while I'm using the insurance company's money, my cash value, all of it, continues to compound.
Great.
Okay, so we've overcome interrupting the compound cycle.
Okay.
And we're able to continue to compound that money while we use other people's money.
Now, if I draw against, and we are obviously obligated to repay.
Correct.
And I'm not really technically drawing against. I'm actually taking out almost a secured loan against the cash value,
Just
right?
like
It's a 6 of one, half dozen of the other.
The
Exactly.
You borrowed my
That's
money.
right. I'm borrowing from the insurance company while my policy grows. So I repay them. Can I repay them significantly more quickly using the techniques that we talk about?
It's set up as a non-structured repayment. Okay, so I could take a lump sum capital loan from the insurance company, go take care of my business that I need to use the money for, and I could pay it back all at once. I could pay it back over time. I could skip payments. I can pay it back when it's convenient for me, when I'm able to pay it back, and when I can pay it back.
And there's absolutely zero relevance between your current credit rating and this specific debt weapon, a very unique benefit.
It's correct.
Okay, good.
So it's as simple as this. I have an insurance contract. It has cash value. I need capital. I call the insurance company and I say, I would like to take a loan against my insurance policy. They look back to see that the cash value can support the loan, and they say, where would you like us to send the check?
Guys, if you can't already see the power of this specific tool, you haven't been paying attention. Now listen, I'm not going to take a lot of your time today. Jim is going to be joining us on subsequent classes. We're going to be doing additional trainings with him and Rebecca Rice. And you guys are all going to be gifted something very special today. I've convinced both Jim and Rebecca to provide you all with your very own complimentary coaching session, just like we here at VIP provide you as well. So in order to make sure you can get access to that, we'll put the link in the description below. That will be an email address that will come directly to us. If you could please go ahead and click that link, send us an email and let us know that you watched the YouTube channel. In the subject line, put whole life. And we'll make sure that it gets in the right hands so that you guys can have kind of a deep dive conversation about the relevance of this information as it pertains to your both short and long-term objectives. Obviously, that does not compete with what we're doing. If you have not yet had your complimentary session from VIP yet, that's an exclusive one-on-one that we provide to anyone nationwide. And it's all done over the phone, very convenient, so we can make sure to include both you and any significant other that you might share your finances with. We'll also be providing access to your cash flow cruncher worksheet. Jim, I just want to say thank you so much for sharing this invaluable information with us. And guys, it's just going to get more and more detailed as to its specific benefits to you. So make sure you take advantage of the gift that Jim's providing you here today. And also check out all of our other videos. Like them, share them, subscribe, and we'll catch you on the next one. Thanks, guys. Appreciate it.